special guest, former Fed Vice Chairman and now PIMCO Global Economic Advisor, Richard Clarida. I don't mean to slightly oversimplify this, but if we're talking about AI, it's an economy that's built on bots, but is that built to last? How do you see that playing out?
Well, we do think it's built to last. We do think this is the real deal. We don't have a crystal ball, Liz. I wish we did. But AI is going to be pushing the economy for many, many years. Right now, it's hitting the economy through the big CapEx push, through the valuation of equities. That's a wealth effect. There's capital spending. Longer term, and already we're beginning to see it show up in the productivity data. So it's really going to be everywhere in the economy, and clearly the U.S. is a global leader as well, which also is an important consideration.
And when you look at the bigger picture of AI and its tentacles, because it's not just, it's also power companies.
Oh, yeah.
We've got all kinds of follow-through when it comes to that. Is it deeper than some people think? Because everybody says, oh, it's just the Magnificent Seven.
Oh, my. I mean, what's interesting, Liz, is it's both very 21st century and very 20th century, because to build the data centers, you need Caterpillar tractors, you need workers, you need power plants, you need power lines. And so it's really both sides of the economy, and we're seeing that now, and we'll continue to see it.
Caterpillar's, I think, leading the Dow, or at least it was earlier.
Good timing.
It's just done incredibly well. There it is, up 2.75%, but at $898. Caterpillar's almost $1,000 a share, but you're right.
Good for them.
Yeah, the demand there is really incredible. Let's talk about how rates might play out into this picture.
Yeah.
People have been waiting for the small and mid caps, the Russell 2000, to truly break out, although I would argue in many cases they have, certainly the Russell 1000. They love to see rate cuts because they borrow a lot of money, the smaller companies. What do you think truly happens this year? Because on any given day, it really doesn't look like we're in for a rate cut anytime this year.
I think that coming into the year, the economy had a lot of momentum, and there was a lot of optimism about inflation falling back to target. I think with the hostilities in the Middle East, the Fed is in wait-and-see mode under Powell. It'll be in wait-and-see mode under Kevin Warsh. I think the Fed wants to see how the hostilities in the Middle East resolve, and they want to get a sense on the underlying momentum in the economy. And so in terms of the timing for rate cuts, I think that's going to depend on the data.
But would you say this year, it's still, you have to see data month by month?
Month by month. I think it's a possibility, but I think the longer this goes on and the longer the strait is shut and the longer there's uncertainty about reopening, I think that really pushes the timeline potentially into next year.
Do we need it? We have very strong earnings. It was kind of interesting to see the 30-year top 5% yesterday. It's slightly below it right now, but this economy looks pretty strong. How do you view it?
I think the economy is strong. I think that there's a range of views both in the profession and on the Fed about when to stop. I think it will depend on both productivity, how fast we grow per unit of labor, and it's also going to really depend on whether or not the inflation tailwinds begin to die off. So I think we're sort of in a wait-and-see mode.
And one last question, and I know this one's wait-and-see as well, considering the war plays such a big part in oil prices, but the oil shock, if it were to end today, how long do you think the high prices last, and does that really, in a much stronger way, push inflation?
Well, I think tomorrow if we wake up and peace is broken out in the Middle East, the experts I talk to indicate it's going to take several months, maybe 5 or 6 months, to get production back up and distribution back up to where it was. But then in the second half of the year, you could be looking at oil prices at a more normal level. And I think that would be good for the economy, and that would be good for planning purposes.
And maybe good for the markets, which right now, folks, we are at session highs. The Russell, the S&P, and the NASDAQ are at records. So good to see you, Richard.
Likewise.
Come back again. Thank you very much.